Hello, this is Jordan. This video is being recorded on Monday, June 19th, 2023. Thank you so much for tuning in today. If you haven't already, please subscribe to the channel. I would really appreciate it. Now, getting into this video, I'm going to talk about what the real turning point should be or could be, and what I think it will be for gold coming up here at some point in the next, whether it's a month or two or 4 or 5 months. And getting into it, that is going to be the steepening of the yield curve. And let me explain why. And this is the only chart I'm going to talk about today in this video. Now I have the capability with the mouse. Showed that in the video I did yesterday. So here we have gold against the stock market, the 2-year yield, and then the yield curve. And the yield curve here is the difference between the 10-year. So the 10-year minus the 2-year yields. Now, we all know, or at least what I've been saying, is the stock market yields, gold. I mean, they're all related right now with respect to what's going on in the markets and the larger macro. And the red here is that's the last Fed rate hike in these cycles. And then the blue is in the rate cut. So last rate hike, rate cut. Last rate hike, rate cut. Last rate hike, rate cut. Although this one should be a little bit more to the right. Looks like I marked that a little bit too soon. But what I want to get into is where the stock market peaked with respect to Fed policy. Because typically what happens is the market goes up as they hike, and then when you get a recession, of course, the market rolls over, and then they have to cut. So it looks like with the recession coming, that's going to be the case this time, and not a soft landing, which, you have also seen that a handful of times over the years. So we're not talking about soft landings. We're talking about when there's a real recession. And so let's look at the stock market. And these black arrows here are when the market peaked. So they stopped hiking here. Now, the market did, it was kind of a double top. The peak was in March 2000, but you also had a peak later in the year. And the peak here was entirely because of the decline in tech stocks. So if you exclude tech stocks, the market peak was really around here. And so, they stopped hiking. The market didn't really fall apart yet, aside from tech stocks. Then the market turned lower. We had the recession. They have to cut. But what's interesting is look at gold against the S&P. So, before they cut and you're over here, this chart doesn't really look that great. Like, yeah, you made a bottom, but it doesn't look particularly bullish. It hasn't moved up. And so this is the point in time where, they stopped hiking, but they haven't cut yet. So, of course, market rolls over, recession, they have to cut. Then, you get the big move in precious metals and in real terms. And so, looking at here when the yield curve was deeply inverted in the middle of 2000, that's when the market peaked. And again, you look at gold and gold against the S&P. There was a positive divergence in gold against the S&P because gold was still trending down here. But, nevertheless, you can see gold really didn't start moving until the market discounted recession, the curve steepened, they had to cut rates. Now, let's go back to 2007 in that period. And so looking at the yield curve again, they stopped hiking here, and the yield curve was already inverted. Here in early 2006, it was already inverted. So they stopped hiking, yield curve remained inverted. But even throughout that period, you still had this move higher in the stock market. So you had that, and then even, the early 2007, middle of 2007, the gold against the S&P ratio wasn't looking, it wasn't bearish, but it wasn't looking that hot. And again, you started having the banking problems in 2007, so it forced the Fed to cut rates probably sooner than they wanted to. But as the market discounted that in the second half of 2007, I think August 2007, you had the cut. Then the curve steepened, and then gold had that big move towards 1,000. Gold against the S&P moves higher again at that point. But so the market here peaked a little late, but nevertheless, when they started cutting in August of 2007. I mean, the market made a new high a couple months later, but it wasn't, you can see here, it wasn't that significant of a new high. I mean, I probably should have, I don't know if this is log scale, but I'll put it in log scale next time. But I mean, you see the point. I mean, it's the same as the last cycle in that gold against the S&P didn't really gain a lot of traction or move up until the yield curve steepened and the market, discounted the cuts before the Fed had to cut. This was a little different here in late 2018, because this was, I mean, I guess you could call it a soft landing. But my point is that, the last hike occurred, right when the market peaked. And that's something, I mean, I mentioned this on Twitter in passing, but, and again, this was kind of a soft landing, but you still had a 20% decline even after they stopped hiking. And while the yield curve, I mean, this, again, every time, every cycle is a little bit different, and this wasn't a recession, but you can see, looking against gold against the S&P, it didn't, I mean, even before, like, let's just move here in early 2019, they were done hiking, but they hadn't cut yet, and so you had this, and yeah, I mean, it was kind of bullish, but the point remains. And so I think what we're setting up for now, this time around, is the stock market is obviously moving higher. And so if you look at, you look at when they stopped hiking, you can look at the black arrows. This is setting up for when they stop hiking, the market is probably going to peak around that time. And then, depending on how weak the economy is, and how long that pause is going to be. I mean, if you have a long pause that's like 6 or 9 months between the cutting, then yeah, precious metals, I mean, they'll move up, but, they may continue to consolidate. But if something's happening, the market's starting to sniff out a recession, bond yields really plunge before they cut, then you're going to see gold break out. And of course, the market will roll over at the same time, because, and this is what history shows. Again, if you're not in a soft landing, the market rolls over when they cut rates. So again, this is setting up for the market is going to peak around the time of the last hike. Oh, look, it could be a month or two before, it could be a month or two after, but that's what I think it's setting up for. And at the same time, we can look at the gold against the S&P ratio. I mean, we've had this nice move up. It's kind of consolidating, but in a short-term sense, I mean, it's really not strong until you push through this resistance here. But it's, these circles show when the Fed cut. So look before these circles, not too hot here, really not too hot. Then the Fed cuts, even not too hot here. So we're seeing the same thing. So to sum all this up, it depends on the market. I mean, the real key turning point is when the market starts to sniff that we're a lot closer to a recession, and you see the 2-year yields start to come down, the yield curve steepens. And, at that point, the Fed has already stopped hiking. The market is this move is going to peak around that time, and then that's what leads to the Fed cutting rates. And that's how you get, big breakout in gold, and you're breaking above this. So to sum it all up, I mean, it's the steepening of the yield curve. That is the key thing we have to focus on. And again, all these things are related. So look for the stock market to peak around the time that the Fed stops hiking. And when the market rolls over, bond yields are moving, short-term bond yields are moving much lower. That's the time when the market's going to sniff out the cuts, the coming cuts. And that's when gold is going to break out. And so, and then the key at that point will be how long is the pause? Because if the pause is only going to be a couple, 2-3 months, that something bad is happening. They have to cut. Gold's going to break out. But if the pause is going to be like 6 or 9 months, maybe gold continues to consolidate over that period. So again, focus on the yield curve. Watch for that steepening, and that'll lead to the breakout in gold. All right, let me know what you think in the comments. Thank you so much for tuning in, and I'll talk to you guys again in the next video.